Look at the figures. It's absurd. It's abnormal. Just a handful of stocks are rising. Those who hold on to these stocks have put the blinders on and believe that everything is just fine. But taking a basket of big names, there has been several months of stagnation. The markets have been pumped up with QE, and there's only one direction this will go: when they pull back. You came here for the truth, so let me unveil that for you. Today, I'm going to share with you some very unpopular views. This has to be said. So let's get into some charts, some articles. Going to talk about Warren Buffett. Going to see what he had done previously and what he's up to today. Lots to cover. And I want to begin with this article out of Bloomberg. In the battle for the first company to reach and sustain $1 trillion in stock market value, don't count out a come-from-behind victory. So this whole article is talking about Apple and Amazon, how these two companies here, number 1 and 2 in terms of market capitalization, where they've come from. And this chart will show you here that Amazon has recently come from behind to be number 2. They are rising rapidly, much quicker than what we are seeing with a lot of these other stocks out there. Their market cap closing in on $1 trillion, and who will reach it first? You could see this here, a 10% gap right now at this time. The gap continues to close more and more. This here shows us what has happened with major corporations, that they can go from big to extremely big. They have benefited much from everything that has happened since the financial crisis. You could see all of the gains that they have been attaining ever since. Here is the race to $1 trillion. PetroChina briefly, just for a moment, reached that $1 trillion mark, did not sustain it at all. And it came down very, very quickly. Now, I want you to keep this company in mind because I'm going to talk about it more later on in this episode. But you'll see the valuations where they have gone. Look at the stock prices where they have gone over time, increasing dramatically, particularly throughout 2017 and onward. There has been a definite rise since that point, all throughout 2017, all the way up until the late January timeframe of 2018. You could see the big names on here, whether it's the tech stocks. We also have Exxon being a very, very big company still to this day. However, not quite what it was years ago. A dozen disruptor stocks account for all world stock market gains. That is completely ridiculous as far as I'm concerned. Many people who do own these will disagree with me. However, if you own them, then you have to understand where your bias lies. Okay? These stocks here, the so-called FANG Plus stocks, Facebook, Amazon, Apple, Netflix, Microsoft, and Google, or their parent company, Alphabet. The disruptors equals the above plus Twitter, Tesla, Alibaba, Baidu, Nvidia, and Tencent. Okay, so we got a few Chinese corporations in there, along with some other names out of the US. This here shows us where the market really stands. It is on the shoulders of just a few companies. Now, these are big companies, but still, just a few, just a handful now. Percentage-wise, of course, we could see where the market has gone. And when you look at the MSCI World Index, compare that, of course, to the S&P, you'll see a little difference of a story. Then we look at the FANG stocks. That's another different story. Things very clearly, as far as I'm concerned, have really, really changed in the last little while. No longer does it matter what you're investing in as long as it's one of the FANG stocks. How much did FANG matter to the S&P 500? You'll see the percentages here. I don't want to get into the details. I really just wanted to show you the fact that a few stocks hold the keys. Disruptors approaching Japan. The Japanese stock market is the third largest behind US and China. What I want to mention about the Japanese stock market right here is that This market cap showing us a $6 trillion market cap, 6 trillion, is owned primarily by the Bank of Japan. They admit to this in order to stabilize their markets. Trillions of dollars have been printed. They own the government bonds. They own the stocks. They own the ETFs. And they pretty much own it all. They are the largest shareholder in many of the companies of Japan. And what would happen if they were to simply let that slowly, over the next year or 2 years, let's say, slowly sell that off back into the market? What would happen to the stocks? Well, they would, of course, crash down heavily. But people don't want to hear that. That is a very unpopular statement to make. Nobody wants to see the value of their money fall down. But that's where we are today. Quantitative easing has created a system that is impossible to reverse. And we will see the effects of that in the coming weeks, months, and years. The 5 largest stocks in the S&P 500. I found this to be interesting. First of all, we are approaching, again, a time frame that we saw during the dot-com boom. A lot of concentration into the tech sector very clearly. But it's nothing in comparison to what we saw back in the 60s. I mean, nothing in comparison. 27.6% versus today, 15%. So I'll show you more details about that. The largest stocks in the S&P 500. At that time frame, 64, we had AT&T owning 9% of the market share. That's massive. IBM, 9%, trading down to 6%. AT&T, you could see how as technology changes, these obviously are affected. Now, these companies here are still big companies, but they don't have necessarily the market cap that something like an Apple or an Amazon does. So we see that ExxonMobil, back during the 2008 crisis, right at that peak of the market, we could say that this was, in fact, the biggest company at that time, Microsoft, in 99 at about 5%. Things have really changed since then. Industry concentration, looking at these different things, whether it was Microsoft back in the dot-com boom and bust, technology was huge around then, 7.7%. Today, the disruptors, in brackets, they're showing us Apple being 15%. So the concentration is what they're calling the disruptors, which is basically tech, has been extremely narrow. Extremely narrow. Yes, a few companies, if we took just the few big companies at that time in 64, they accounted for a lot of the percentage of the S&P. But it wasn't just focused into one market. Even during the dot-com boom and bust, we saw a difference. We saw much difference. A market cap that was more spread out. Not today. Not today at all. Just a few stocks. All right. Warren, the insider Buffett, is boosting his stake in Apple, having pundits predicting it is poised to hit $1 trillion in market value. But the iPhone maker isn't the first to tread that lofty path. If you remember back a few years ago, now over a decade, PetroChina crossed the milestone back in November 2007. I remember this day specifically, when its mainland shares almost tripled in value in their Shanghai trading debut. But the state-controlled energy company dropped below that level within a day, falling below $500 billion in March of 2008. And I remember how hard this stock was falling. And there was a lot of individuals out there saying, now is the time to buy. Now is the time to buy. Some of them did buy. It now ranks fifth among Chinese companies. So we're talking about still huge, obviously. Well, it talks more in the details about the history of it, but I wanted to bring you back into the pages of history to look at this. October 2007, Warren Buffett did an interview. Buffett said that he sold his entire PetroChina stake, and he sold it not because of what was happening, the issues that they were experiencing, but because the price went too high. It was 100% a decision based on valuation. He also admits that he sold too soon, given the fact that the stock had continued to rise to all-time highs in recent weeks, even as he was selling. So I want you to note what Warren Buffett has done. He doesn't often buy a stock to then sell it, okay? And I think that it mentioned somewhere on here that he initially bought it in 2002, but don't quote me on that. So he held the stock for a 5-year period, let's say. He saw it rising like crazy, all right? He saw it going crazy. He thought, I've made enough money, I'm going to sell my positions. And he did that. Made a killing. He made a killing along the way. There's no doubt. And in doing so, he was able to reap the rewards for his investors. So they made money. But the stock continued to rise. A lot of people who probably bought in when he sold saw their valuations going up higher and higher in that stock, saw their portfolios gaining, and they were so happy and proud. Unfortunately, things took a turn for the worse. Nobody expected it. You could say, oh, well, there was nothing to do with China. We had nothing or no reason to worry about this particular organization. It's still around today, still a huge company, but the stock dropped significantly. And why? Was it because Warren Buffett sold? No, it continued to rise long after he sold. It's because of an external event affected the whole market, bringing it all down. It doesn't matter how many iPhones Apple sells. It doesn't matter how many Prime subscriptions Amazon is selling. It depends on what's happening in this market. When there's quantitative easing and they pull the rug from underneath it, it's going to collapse everything. If you found this video informative, please give me a thumbs up. If you support alternative information, give me a thumbs up. If you hate me, give me a thumbs down. Share your thoughts. Don't just be a spectator. If you want the financial education that was not taught to you in schools, then these two books have it all. It covers it from top to bottom, A to Z. You can get that at Amazon. The link is in the description of this video. If you're more interested in the audiobook version, you can get that at themoneygps.com.